Greetings and welcome to Module 5. You've come a long way so far. Module 4 was pretty intense, so congratulations on completion. We're now going to go a deeper dive into GAAP. We're going to jump in and find out more about when do we recognize things and how do we recognize things. There are a bunch of rules to follow. So when is a sale a sale? When can we say a receivable is a receivable? Are we going to be paid everything that we're owed when we send out a bill? By the way, probably not. And then expenses. We've talked about matching before, but also some other expenses like research and development, which do need to be expensed right away. We don't capitalize them, meaning put them on the balance sheet as an asset. We put them on the expense side of the house. So we're going to take a deeper dive in this first section into revenues. So when is a sale a sale? How do we apply the rules of revenue recognition? Well, there were some major changes that came about in 2017. We always wondered, did I sign a contract? Is that a sale? I got paid money. Is that a sale? Or is it the change of ownership, the transfer of the rights to use whatever asset, or having received certain services? When is that time to recognize? So let's talk about what's called RevRec, the Financial Accounting Standards Board's revenue recognition rules, effective the end of middle of December 2017. The key takeaways and the bottom line is recognize revenue when the company transfers the good or service to the customer. And the customer must obtain control of that good or service, can do what it wants with it. And it is not necessary to receive cash to recognize revenue. That's cash basis, not accrual basis. But we're going to talk about the 5 rules that you're going to want to know when it comes to RevRec. A couple of comments though. Many sales on credit mean the customer has agreed to pay the company in the future. So that's what, when they agree, they say, yep, we got some stuff, we're going to pay you in the future. Sounds like a sale. Company recognizes revenue when the goods or services is transferred and records a receivable to be collected later. Okay, that sounds legitimate. The customer says, we'll pay you. Revenue recognition is unaffected by delayed receipt of cash if the company has fulfilled performance obligations. Note the word performance obligation. We're going to talk about a bunch of performance obligations that really confirm whether a sale is a sale. I want to make a note here. Credit card sales are considered cash sales, not credit. So if a credit card sale is made, it's not accounts receivable, even though you say, wait a minute, we're going to get the money. Well, they usually get the money within 24 hours, maybe 48. But the key is that a cash sale or a credit card sale is considered as a cash sale. So let's look at the 5 steps to the rules of RevRec. Excuse me. We want to identify the contract with the customer. So we're going to say, okay, we've got a specific agreement. And we have identifiable elements. We'll talk about performance obligations in a minute. And the terms of the sale should be specified, not, we think we know what it's going to cost, but it may change. And you know what, whenever we get it as soon as possible. A little more definitive on that to have a really tracking mechanism to record a sale. The key is finding performance obligations in the contract or the agreement. It's a contractual promise to transfer a good or service to the customer. And when there's more than one good or service, they must identify separate performance obligations. So there might be multiple obligations, and each can be tracked separately for revenue recognition and tracking. You need to be able to determine a transaction price. And you can make some estimates sometimes, but you have to be reasonably assured that that is a reasonable estimate to work with. We talked about multiple performance obligation elements that are being met. And if you might have to allocate the transaction price for each one of those. So each level of performance, I get to this. Good, I recognize revenue, I get to this. I recognize revenue, I get to that. And if standalone prices are not available, kind of reasonable estimate of selling price or allocation of the price to those performance obligations. And then RevRec has a time frame attached. So performance obligations is when the customer obtains control. It's all about control. Performance obligations satisfied over a period of time should be recognized over a period of time. So thinking about that, if we have obligations, 5 or 6 things we need to do, we recognize revenue at at the accomplishment of each one of those elements as they go. It's nice that in the footnotes, which is part of the annual report and integral to the report, the 10K, revenue recognition, this is Pfizer, we determine transfer of control based on when the product is shipped or delivered and title passes to the customer. And there are actually some gap talking about when it leaves my loading dock or when it arrives at the loading dock of my customer. When does the transfer happen? Something called free on board, not to worry about it, other than it's something to understand that some people say I shipped it, it's a sale, or until I receive it, it's not a sale. So there's some discussion, and we can do a deeper dive at some point. And companies are very obviously concerned about that, because just because it's not an inventory physically sitting on the shelf doesn't mean you don't own it. Or just because you do have it, there are consignment goods we'll talk about a little bit. That means that we are holding on somebody else's goods. Chargebacks, rebates, sales allowances, sales returns are deducted from gross revenue. We talk about net revenue. And when is a sale a sale? Well, if you give a cash discount, you're never going to see that cash. You can't include that in sales, and that's sales. If you get a return, if a customer says, here, take it back, well, that's not really a sale either, because you got to deduct it from your gross sales to get to net sales. So we're going to be differentiating between gross and net sales as well as we talk about these things. Complications, we might have some non-refundable upfront fees. Well, when we get those fees, we actually recognize the revenue when goods and services are provided. Because if for some reason we don't provide the services or goods, those non-refundable fees, they may be at risk. Bill and hold arrangements. Who controls the goods? When do they transfer to the customer? Consignment sales, as previously mentioned. When goods are sold, I mean, when the Pepsi truck's out there, ever try to go to the supermarket and you're looking for something on the shelf and you ask the wrong person, you say, I'm looking for, and you say, it says Pepsi. I work for Pepsi. They stock the shelves. It's consignment goods, and they don't record the sale at the grocery store until it goes through the counter. It goes through the checkout counter and checkout lines and the cash registers. Then it's a sale, and the goods are commissionable to Pepsi, but otherwise they own what's on the shelf. A lot of breads do that. A lot of canned goods. There's a bunch of things that are doing that. And there's licenses. And Rev Rec depends on the contract, right to use, promised access, and finally franchises. Recognize revenues as goods or services are delivered by the franchisor. And then complications, variable considerations. We may not know the exact amount we're going to get. We need to be reasonably assured that we're going to get paid. If we don't think we're going to get paid by the customer, if for some reason there's doubt, we can't record a sale. Multiple elements, multiple performance obligations, we talked about those. And then the right of return. Is it really a sale? If 90% of the time you give out on a free trial, say, here, I'll ship you the stuff for free, you try it, and if you don't like it, just ship it back. If there's a good chance that someone's going to really keep that, yes, it's a sale. If 95% of the time someone's going to return it, it's not really a sale. So we've got some decisions to make. And then gift cards. Recognize when gift card is used or expires. So we have an obligation to perform as unearned revenue as a gift card, because it's not real revenue. We can't say, great, we got $1 million in gift card sales. Well, that's an obligation. So we need to account accordingly. And then here, we mentioned net revenues versus gross revenues. You always see on the income statement, almost always, net revenues. So they already took out the adjustments. They already backed out things that were returned or sales discounts, cash discounts, returns, allowances, everything that goes with that. You've seen the income statement before, cost of sales or cost of goods sold, selling in informational and administrative instead of SG&A is SI&A here. R&D expenses, we mentioned R&D always shows up as an expense. But you say, wait a minute, what if some of those buildings or assets I get can be used for other things? There's room for discussion. Most of the salaries, most of the research, that is expensed right away. Amortization of intangibles as opposed to depreciation of tangibles, restructuring charges and certain acquisition-related costs. But by the way, Pfizer income statement, they include that, yeah, they have intangible asset amortization. Yep, that's Pfizer. drug company, intangibles are part of their mainstream operations. So we're getting down to income from continuing ops. We just went through module 4, talking a lot about operational expenses, operational income, and non-operational stuff like discontinued operations, gain or loss on disposal of those operations. Notice those are net of tax. And then net income from allocation of non-controlling interest. We want to get to the bottom line, to the common stockholders, where it's at. So that's what we're doing. That's where we're going. And RevRec is key. And if you want to talk to an accountant about RevRec, they'd love to chat. Thank you for listening on the first module. We'll soon be at module 2.